Hey everyone, welcome back to Corporate Decoder, the place where we unpack some of the most complex corporate documents to bring you the juicy details. You probably missed Invest Green Acquisition Corporation is prepping for its big moment, its initial public offering, or IPO, and they've filed a ton of paperwork with the S. C telling us all about their plans, risks, and financial situation. It feels like a classic SPAC story setting out to find a business to merge with. But let's dig into the numbers and the strategy to see what really makes this company tick. This is a filing from the 26th of September 2025, and it's an amendment to their original filing, meaning they're updating some information potentially based on feedback or changes in their plans. This registration number is just how the US Securities and Exchange Commission, or SEC, keeps track of their filings. The company is called Invest Green Acquisition Corporation, and it's formed in the Cayman Islands, which is a common practice for these types of companies. They list a New York address for their principal executive officers, suggesting the operational heart of this company is in the US, even though it's incorporated elsewhere so they can operate efficiently in the American financial markets. This document is essentially a prospectus, a document companies use to offer securities for sale to the public. Since it's an amendment, it's important, but it might be updating crucial details, so let's zero in on the key aspects that can affect investors like you. This is a preliminary prospectus, so it is not yet finalized. These are the initial details for potential investors. Things could still change before the final version is effective. Invest Green is aiming to raise a hefty $150 million. They plan to do this by selling 15 million units. The key here is that each unit is not just one share, but a package deal. So you buy a unit for $10 and you get one regular class a share plus something called a right. And this right sounds interesting. It gives you the chance to get another tenth of a class a share later on if the company actually manages to buy another business that is their main goal here. Now here is where things get interesting. The company S sponsor, IG SPAC sponsor, LLC is buying an additional 480,000 units, not directly from the public. But in a private deal, this is a common move for SPACs where the sponsor shows commitment. Here is a number that catches the eye. The sponsor bought founder shares for just $25,000. That sounds incredibly cheap considering the scale of this offering, and it hints at a significant dilution for public shareholders, a point they themselves acknowledge later on. These founder shares are like special shares that will convert into regular class shares. Later, this conversion ratio is crucial, and they mention it can be adjusted, which could lead to more dilution for other shareholders, a very important point for anyone considering investing. A significant risk they flag early on is that their top people have other jobs. This raises concerns about whether they will have enough time to focus on making this SPAC successful. And naturally, this could create conflicts of interest when it comes to making big decisions like choosing which company to buy. They have a deadline 24 months to find a business to buy and merge with. If they don't, they will have to dissolve and return the money to investors. This is a standard SPAC feature, but it adds pressure to find a deal quickly. They want their units to trade on the NASDAQ, a major stock exchange, which is a positive sign for liquidity and investor access. So as expected, they are a blank check company, meaning they exist to buy some other company. They have not identified a target yet, which means there is a lot of uncertainty ahead. Their focus area for acquisitions is interesting. They are targeting renewable energy, sustainable finance, and nuclear energy sectors. They believe these are crucial for the global clean energy transition, and they specifically mention data centers as a growth area due to increasing energy demand. Their management team seems to have a background in these very sectors, which is a good sign. They believe their management has the experience to identify and execute deals in these areas. Their CEO, Andrew McLean, has a strong background in sustainable finance and environmental initiatives. He even created a show called The Eco-Capitalist, which certainly fits the Invest Green name. Their CFO, Jim Campbell, has experience in SPAC investment banking, which is highly relevant. They have also worked at EF Hutton and MUFG Bank. Michael Krawchuk, their Chief Business Development Officer, also comes from Invest Green, bringing experience in investment management and capital growth. Looks like they have some new director nominees joining the team. David Dussault has experience with Robinhood Securities, which is quite a name in fintech. Eric Luo is slated to chair the board and has a very senior role at Longi Green Energy Technology Co. Ltd, which is a big player in green energy technology. Jing Nialis is another independent director nominee and has CFO experience at CSAI Corporation, a battery developer. Francisco Sanchez brings a wealth of public sector experience, including a role as US Under Secretary of Commerce for International Trade. This kind of background can be very helpful in navigating complex deals, especially those with international implications. They emphasize their disciplined approach to finding deals aiming for strong risk, adjusted returns. This section really highlights their market opportunity. They are zeroing in on high growth industries and specifically mention data centers and their massive energy demands as a key area. This implies businesses that can provide sustainable power for these growing data needs will be prime targets. They provide some market stats here. Nuclear power is expected to grow, and that fits their focus on clean energy solutions. Now onto the financial acrobatics. The dilution table is always a key part of SPAC filings. This table shows how much value is lost for new investors compared to their initial investment price. Looking at the NTBV, or net tangible book value, per S-Hair here is where it gets a bit stark, the NTBV. Per S-Hair is very low compared to the $10 offering price. For example, without exercising the over-allotment option, and with maximum redemption, the difference between the offering price and NTBV is almost the entire $10. This shows a massive potential dilution for public shareholders right from the get-go because of those cheap founder shares. Remember those founder shares bought for $25,000? This dilution table really emphasizes that point investors are essentially buying into a company where the insiders have an extremely low cost basis, and that has a significant impact on the value per S-Hair for new investors. The founder shares, the sponsors Class B ordinary shares, are a big talking point. They will automatically convert into class of shares later, but the document details adjustments to that conversion ratio that can further dilute public shareholders if the company issues more shares than initially planned, a critical detail to watch. Right now they have 0 Class A ordinary shares issued, but after the offering they will have 780,000 plus the shares in the units themselves. This shows just how much capital is being raised to create a new company structure. After all the upfront costs like underwriting fees and legal expenses, they are left with about $150 million from the public offering, plus the private placement money. And crucially, $150 million of that money goes directly into a trust account. This money is ring-fenced for the business combination and can't be touched for anything else until a deal is done or the company liquidates. They do mention that they are not prohibited from merging with a company affiliated with their sponsor or officers. This is a potential red flag for conflicts of interest, although they say they would seek an independent opinion to ensure fairness. The sponsor and initial shareholders will own 25% of the company after the offering. This gives them significant voting power, which could influence decisions that public shareholders might not agree with. A final warning for investors: incorporated in the Cayman Islands means dealing with different legal rules than in the US. This can make it harder for investors to protect their rights if things go wrong. Now, looking at the bigger picture here, Invest Green Acquisition Corporation is trying to capitalize on the green energy transition by finding a high-growth company to acquire their management team, has relevant experience, which is a positive, but the financial structure with those cheap founder shares and potential for dilution is a significant risk. Also, the tight 24-month deadline for a deal adds pressure. So what is my take on this filing? They have a clear strategic focus in a growing sector and a management team with industry connections. However, the dilution from founder shares and the potential conflicts of interest outlined in the filing are substantial risks. Investors need to be aware that the low cost basis of the initial shares means the sponsor could profit even if the stock price declines after a deal. It really comes down to whether you trust this management team to find and execute a good business combination within the given timeline and navigate the complexities of a green energy acquisition, all while managing those inherent conflicts. It is a high risk, high reward scenario. Alright, that is our breakdown of Invest Green Acquisition Corporation's latest filing. What is your take on these numbers and what they signal for the company? As future, drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.